David Guttery is the Chief Executive Officer of InSOURCE Financial Advisors of Lincoln, Nebraska. David Guttery and Seth Edgell are financial advisors who represent Emeritus Investment Company, LLC, and Emeritus Advisory Services. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone. I'm Seth Edgell, a financial advisor with InSOURCE Financial Advisors. Today, I'm joined with our CEO, David Guttery, to talk about current market and economic conditions. David, as we are advising our clients, we often draw reference to how economic forces shape and impact our investment advice and portfolio construction. Sometimes geopolitical events can influence that advice as well. So in light of recent developments with Iran, what advice would you give to our viewers at this time?
Seth, at the beginning of the year, we talked in detail within that video about encouraging signs that were just beginning to build and suggesting that the economy was gaining traction and expanding in a positive direction. Over the course of the first quarter, I believe that we've seen that pattern gain increasingly greater momentum. It's frustrating that within an election year, the media has become a deafening cacophony of noise. Now, whether it's the Epstein files, or the SAVE Act, or ICE deportations, Venezuela, Iran, or the recent Supreme Court ruling regarding tariffs, you would never know that the economy is on such solid footing if your only input came from the nightly news. Well, I guess that's where we come in. It's our job to wade through that sensationalism and get down to things that we can quantify on a spreadsheet as we're helping our clients navigate through periods of time such as this. Now, likewise, we're helping clients navigate periods of uncertainty and identify potential opportunities for growth as we are helping them to recognize and avoid potentially hazardous exposure to overly valued areas of the market. Over the last 2 years, we have talked on many occasions about a narrow sleeve of stocks that have come to be known as the Magnificent Seven. And since the recent market high established on the 18th of January, I believe that we are seeing a discernible retracing of gain and weakness in this area. At a high level, I would advise our viewers to remain with a long-term outlook, with a greater focus on the goals that we're trying to accomplish, rather than being distracted by fear-induced mass media sensationalism.
Let's unpack these one at a time, and let's focus on the Magnificent Seven first, because indeed, we've seen some pretty significant weakness in this area recently. You've consistently cautioned our clients that, in your opinion, there are many parallels between what we see today with the Magnificent 10 and what you saw 25 years ago as the dot-com bubble burst. How do bubbles build in the first place, and what makes them burst? What's the difference between trying to catch a falling knife and being greedy when others are fearful?
Great questions. Before we dive into that, however, let's first observe that as of Wednesday, the 15th of April, the market, as represented by the S&P 500 index, has seemingly recovered from the geopolitical turmoil-induced sell-off that we observed at the beginning of March. Now, having said that, weakness remains among the Magnificent Seven. So let's look at these stocks and their performance since the recent highs that were established on the 18th of January. You can see on this graphic that as of the market's close on the 25th of March, all 7 of the stocks were significantly in the red, with Microsoft leading the way down over 33%. If you look at the weight that each of these stocks carry in the S&P 500 index, you're looking at nearly 30% of the index with just these 7 stocks. What are the catalysts that could precipitate the reversal of gain? Well, it could be that we are simply into a new tax year and it's time to reallocate gains from maturing positions. It could be that a geopolitical event like the war in Iran is a catalyst that accelerates that sentiment. Frankly, it could be that the market collectively realizes that maybe these valuations have appreciated too quickly and that current financial metrics simply do not justify present trading valuations. I think in the case of Microsoft, it could have something to do with almost negative free cash flow. Some of these behemoths have spent billions of dollars on generative AI, and at least for the time being, we do not have the expanding multiples that we anticipated, and frankly, we don't have a positive return yet on those invested dollars either. I think there's more truth, however, to be found with a much more high-level analysis. One thing that is true about all parabolic moves is they've all come to an end. There has never been a bubble that hasn't burst. In my opinion, this one won't be the first. We keep asking ourselves, is it different this time? That's the wrong question. The question we should ask ourselves is, where are we in the cycle? As it becomes increasingly obvious that expectations were unrealistic and positions have become untenably crowded, that is when, in my opinion, it would be best to avoid the sector altogether. I mean, who knows what the catalyst will be responsible for precipitating the burst of the bubble or the timing of that burst. If you see a bubble, avoid it. It's just that simple. I remember very clearly business commentators trying to convince me that it was okay to buy another share of JDS Uniphase in March of the year 2000 and that I should be perfectly comfortable paying a 668 multiple to its current forward PE in the process because, after all, technology is going to revolutionize our lives and it's going to look cheap in 10 years. Well, technology did indeed revolutionize our lives, just not in 1999. And since then, JDS Uniphase doesn't even exist anymore. I think we can put the thought of it looking cheap in 10 years into context as well. Different companies, different multiples, same rhetoric. I've heard the phrase, it's different this time, ad nauseum. Well, for those who still cling to that hope, I would like to offer this graphic looking back at the dot-com bubble burst. It appears that technology hit its peak on the 27th of March in the year of 2000. From that point through the end of the year, we saw significant weakness in the technology sector. That was supposed to be different this time. As of the year 2000, as it drew to a close, observe where markets saw leadership. Consumer staples, utilities, healthcare, financials, industrials. These were very undervalued areas that no one wanted when the high-flying dot-com stocks were all the rage. Berkshire Hathaway apparently saw the wisdom in holding this exposure, didn't they? Over the next 2 years, while the S&P 500 was down 49% and the NASDAQ was down 77%, Berkshire Hathaway was up 80%. They own the stocks of the companies that no one wanted when technology positions became overly crowded and valuations became untenably high in that sector. So back to this chart for a moment. Time will tell, but so far, it appears that tech may have peaked on the 29th of October last year. We're seeing a similar pattern develop, and again, only time will tell whether if it persists, but so far, it seems that we are seeing significant leadership weakness in technology in favor of materials, staples, industrials, and other areas that no one wanted over the last 4 years, as a 40-year inflationary high sparked yet another massive wave of CapEx spending on efficiency technology. So for those who would like to believe it's different this time, clearly I can't guarantee that they're wrong, but I do know that every bubble that has ever built has burst. They've burst for different reasons because of different catalysts, but eventually they burst. This just underscores the need for being persistently mindful of where risk is allocated, where opportunities may be for growth. As to your previous question about what makes a bubble build in the first place, it's usually the result of an innovation trigger. Over 30 years ago, it was the realization that, hey, our computers won't work by the end of the century. Remember, we did not reprogram trillions of lines of code. The Federal Reserve did then what they've always done. They printed a record amount of money for the time, made it very available and almost free. Companies borrowed and bought their way through that crisis. And we resolved the problem with new technology and hardware. Ultimately, what made the bubble burst was a discernible end to the crisis. At 12:01 a.m. on the 1st of January, that crisis was over. We had a wealth of new machinery and no need to buy anything else for the foreseeable future. Purchasing ran dry and the Fed turned off the easy money. It didn't take long before the realization set into the market that expectations for the future were likely not to come to fruition, which touched off a massive retracing of gain over the course of the year 2000. This time, I believe the innovation trigger was hitting an inflation high that took 40 years to build. If I must sell 10 of these things in order to stay in business, but you're only buying 7 of them, I better figure out how to make fewer of them with the same profit margin, and fast. That is what, in my opinion, drove yet another record amount of narrowly focused spending on technology to achieve greater efficiency, to meet the impact of that inflationary crisis. Unlike the burst of the dot-com bubble, however, I don't have a discernible line in the sand as to when this crisis event might resolve. We can look at current measures of inflationary change, however, and see that we don't have nearly the inflation problem today that we did 4 years ago. So if the crisis that drove the spending initiative in the first place is no longer a crisis, then at what point do we evaluate the current valuations of companies that benefited from the spending? I think that might be underway today. Bottom line, not all bubbles build in the same way and they don't burst in the same manner, but I would challenge anyone to point to a parabolically overvalued market segment that never burst. Again, I think we're early in this cycle, and I would caution people to know the difference between a falling knife and the opportunity to be greedy when others are fearful. Referencing the dot-com crash, as that began to unfold, the rhetoric was buy the dip, until it became run for the hills. We're early in this cycle, and only with time will we know clearly for sure, but in my opinion, there are other areas of the economy that offer more compelling valuations. I know that was a long answer, but that was a loaded question, so what's next up your sleeve?
That it was. David, let's talk about the economy for a minute. You mentioned that median noise is drowning out otherwise good economic data. And the observation of that data, can you expound upon what you're seeing in the economy that makes you feel so positive at this time?
Absolutely. And as you've heard before, a picture is worth 1,000 words. So much to the dismay of our videographer, I am going to draw reference to several of these in sequential fashion. Again, I am most persuaded by quantifiable data on a spreadsheet. This, in my opinion, is not a recessing economy, but rather a very strong growth economy. You again are buying more things, and I can prove it. So let's take a look at some of these data points. Industrial production is at an all-time record high, and it continues to climb. To me, I believe this is the result of tariff-induced repatriation of manufacturing activity. We can cross-check that by looking at the ISM Manufacturing Index, which recently showed us the fastest expansion in 3 years. In February, the Wall Street Journal took note of this, and you can see that curious, sharply positive result on the right side of the graphic. The slope to that line is nearly 90 degrees. That was a copious and sudden entry into expansion territory, and since then, we've seen 2 more readings just like it. Factory output is at a 4-year high. Our trade deficit is at a level that we haven't seen since 2009. In my opinion, this is because we are exporting increasingly greater amounts of goods under the new trade agreements that were codified last year, and because we are manufacturing more things domestically, we're importing fewer things, and as a result, the trade deficit is narrowing. All of these data points are, in my opinion, a very positive referendum on the industrial side of the economy. Curiously, our capacity utilization hasn't budged. It would appear to me that we are bursting at the seams of our capacity to keep up with increasingly greater demand for products. Think of a bubble. There's only so much air that it will hold before it bursts. My question is, how much longer will manufacturers be reticent to invest into capital equipment and human resources to run the machines, to pull the levers, push the buttons, to make the things that you are demanding in greater quantities? I think that we are on the cusp of seeing that happen. Ironically, we observed a very similar trend in 2018. In February of that year, jobless claims hit a 45-year low. In March of that year, payroll gains began to increase with significantly greater traction throughout the year and continued to expand rapidly until COVID impacted the economy a year and a half later. Well, once again, jobless claims are at a 45-year low. It doesn't appear that we're laying off many people. It doesn't appear that people are quitting. It would appear that we need everyone that we have and that we are working 24/7, 365 shifts in our attempt to keep up with increasingly rising demand. I have long contended that the Federal Reserve will be a critical part of future employment gains. Now, I know this chart looks busy. All you need to know is that the higher the number, the less restrictive lending conditions are. Looking at this chart, I can make you the argument that global lending conditions are as lucrative as they have been since 1988. For clarity, I was a sophomore at the University of Alabama at that time, so it's been a long time since lending conditions have been this lucrative. We all remember what happened in 2020 during the pandemic. The Congress promulgated a myriad of spending measures, and the Treasury auctioned a record amount of debt to fund those measures. And the Federal Reserve printed a record amount of money to buy those bonds onto their balance sheet. In the subsequent year, the Federal Reserve began to drain those lendable reserves through a process called repo operations, pulling those dollars back onto its balance sheet and out of the lendable supply. Looking at the Federal Reserve's repo budget, we can see all of that money being drained from the lendable supply out of the economy until about May of 2023. Quietly, the Federal Reserve has been putting every dollar back into the economy through a process called reverse repo operations. Therefore, today, the lendable money supply is at the highest level that we have ever seen in the history of the United States. Following 3 rate cuts, the secured overnight financing rate is dropping sharply, and that is creating an environment that is as supportive of employment improvement as we have seen in quite some time. Indeed, 2 weeks ago, I believe we saw the first of what could be several surprise employment figures. The headline number of 188,000 private payrolls was not that impressive. What was impressive is that it was 3 times higher than the most optimistic estimate from economists. Again, we saw something very similar headed into 2018, and by February of 2019, the ISM Manufacturing Index had established an all-time record high, propelled there by what was then a tariff-induced repatriation of manufacturing activity, and we see that happening again today. History doesn't always repeat itself, but it can very often rhyme. Looking at this historical depiction of the ISM Manufacturing Index, just know that pink is bad and white is good. Any reading above 50 is indicative of expansion. On the far right of the chart, we can see this sharply higher reading that the Wall Street Journal also noted earlier in the year. Since then, we've had 2 other positive readings as well. And right now anyway, it seems that we are seeing the same pattern develop that we observed throughout 2018 into 2019. Furthermore, I would suggest that this is a year where you would be better off watching what people do rather than listening to what they say. When the media tells you that the consumer confidence is at a low point, please understand that the University of Michigan filters that by gender, ethnicity, age, and political affiliation. When you dig more deeply than just the headline number, it would appear that Republicans are euphoric and Democrats are seemingly waiting on the Great Depression. So, at this time, I have very little faith in what the aggregate consumer sentiment number has to offer. Indeed, I am observing that we apparently can't travel to foreign countries fast enough. And it would appear that we are doing so while wearing a Polo Ralph Lauren shirt. Polo Ralph Lauren hit 3 all-time record highs last year. You don't buy more Polo shirts if you're struggling to put bread on the table. Last year in the playoffs, Indiana beat my Alabama Crimson Tide, and then I became an Indiana fan for the rest of the year. Why not? Pull for the underdog, right? I know it's been since World War II since Indiana found themselves playing for a college football national championship, but good grief, somebody paid $3,400 to sit with the Pigeons on the top row in the end zone. And if that isn't impressive enough, according to SeatGeek, these were record premium prices for single tickets to the Super Bowl. Recently, Live Nation reported record high revenue from concert goers. Look, I love the Eagles just as much as anyone else, but you don't pay $500 for a seat to see them at the Sphere if you're having trouble putting beans on the table. None of this is indicative of an economy in contraction mode. To me, this is quantifiable evidence that we have a growth economy underway, but you would never know that if your only source of input was the media. Drill, baby, drill, right? Not hardly. Oil production would not be at an all-time record high if demand weren't also at an all-time record high. I can't remember a recession that ever started with oil demand at an all-time record high. So just remember, the business media is there to entertain you and in some cases scare you to death. Their objective is to glue your eyes to the television long enough to watch 3 commercials, but not necessarily to give you actionable information. That's only going to get worse between now and November, so my advice is to watch the Golf Channel or a cooking channel. Please don't be satisfied with superficial observations. Critically question, what is the objective of the source? Are they trying to get you to vote for a candidate or align your views with that of their political party? Or are they truly giving you dispassionate and actionable information? Do your own research. Bottom line to me, yes, I am very encouraged about what I can put on a spreadsheet and what that is telling me about the current and potential future state of our economy. I think that we are on very strong footing.
I agree. And I think you've summarized this well and offered a great amount of data that hopefully our viewers can use as balance against election year rhetoric. David, in closing, what are your final thoughts regarding bringing planning objectives to a successful fruition?
Well, this will be my shortest answer of the video. Again, be diligent, do your research, but at the end of the day, be mostly driven by objectives that have been codified in a well thought out and actionable financial plan. Meet with your financial advisor often and evaluate results against planned objectives and correct for variance along the way. Remember, this is a marathon. As it pertains to periods of market unrest, I've used this analogy often. Think of this ball as a stock of a company, and the water is the economic environment that supports the sector within which it lives. As the economic environment improves and there's more water, the ball will rise. Likewise, if the economic environment is weaker and there's less water, the ball will fall. Sometimes, though, you get this artificial force that holds the ball underwater. You have to be dispassionate to diagnose the nature of the force and try to discern, is this technical or fundamental? Should the hand be removed from the ball, then physics tells us that the ball will return to the surface of the water where it is supported at economic equilibrium. Last year at about this time, the CNN Fear Index registered a 4. I've never seen a 4 before. The index only goes to 0, so exactly what were the markets so gripped over with regard to fear? Maybe it was President Trump's approach to tariffs and the Federal Reserve and the idea that they would leave rates too high for too long. All right, I couldn't translate any of that to a spreadsheet, so to me, it seemed like we had a huge hand holding the ball under the water. Indeed, that sell-off was historic. We hadn't seen the market down that much in any 8-week rolling period of time in 100 years. And then, without warning, markets apparently realized that those fears were overblown and dire assumptions would likely not come to fruition. The hand came off the ball, and the ball returned to the surface in the form of the fastest recovery that we had seen in 75 years. Welcome to my world of whiplash. Make sure that your exposure to risk is appropriate. If you're later in life and deep into retirement, then you probably don't have the capacity to take on an exorbitant amount of variable risk. That's going to be different for everybody, so put your thumbprint on the approach to how your plan is implemented. Sometimes problems can arise when people hear anecdotally about the success of their friend or their coworker, and then they try to mimic that behavior only to find out that indeed it came with more risk than they were comfortable in taking. Have a plan and a roadmap to achieving that plan. Stay within those boundaries while making periods of market unrest work for you by keeping your eyes on the long-term horizon.
Thank you, David. For additional information, David may be reached through the means listed upon the following screen. For InSOURCE Financial Advisors, I'm Seth Edgell.
David Guttery and Seth Edgell independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segments is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.